Buying a custom 300-foot super yacht requires an immediate wire transfer of hundreds of millions of dollars. To acquire assets at this scale, liquid cash is the only currency that matters. Yet the founders who dominate these markets often have no traditional paycheck. Elon Musk, for instance, has operated with a base salary of exactly $0 for years. The standard assumption is that these billionaires must be selling off their company stock. To fund their lives, they simply convert a fraction of their ownership into cash. But cashing out carries a heavy mathematical penalty, the capital gains tax. The moment they realize those profits, the government claims nearly a quarter of the total value. Because selling destroys wealth accumulation, the ultra-wealthy avoid cashing out. Instead, they've adopted a framework that allows them to spend millions while keeping their assets untouched. They utilize a legal loophole that extracts spending power from their portfolios without ever triggering a sale. This strategy is known as buy, borrow, die. It operates on the principle that it is always more profitable to stay rich on paper. This three-step process creates a permanent divide between a billionaire's spending power and their taxable income. The buy phase is about accumulation. It involves acquiring high-growth assets, like tech stocks or real estate, and holding them for decades. Under IRS rules, these are classified as unrealized gains. No matter how much the value climbs on paper, the owner owes zero in taxes until the asset is officially sold. By refusing to sell, wealth compounds in a completely tax-shielded environment. In this system, realizing a gain is seen as a strategic failure. This raises a practical question. If you never sell your stock, how do you pay for a new mansion or a fleet of private jets? That is where the borrow phase begins. Instead of selling shares, the wealthy use their unsold portfolios as collateral to secure massive lines of credit, known as securities-backed lines of credit. Federal law does not classify loan proceeds as income. Because the money must technically be repaid, it is considered debt, making it entirely non-taxable. Compare two strategies. Selling $100 million in stock triggers a $24 million tax bill. Borrowing against it triggers zero tax, just a modest interest fee. If the stock grows at 10% and the loan charges 5%, net worth increases despite the debt. Because billionaires pledge liquid billion-dollar portfolios as collateral, banks offer them institutional interest rates that are far lower than anything available to a standard consumer. The capital gains tax saved by not selling creates a massive tax subsidy. That saved money can cover the cost of the loan's interest for decades before the cost of borrowing even approaches the cost of the original tax bill. Through this arbitrage, the wealthy are effectively paid to borrow money, allowing their net worth to grow faster than their liabilities. There is one final obstacle. Eventually, the bank must be repaid, and the accumulated debt must be settled. This is the die phase. Upon the asset owner's death, a specific provision in the tax code is triggered, the step-up in basis. The step-up legally resets the original purchase price of the asset. If a founder bought stock for $10 million that is now worth $1 billion when they die, the heirs receive it with a new cost basis of $1 billion. The accumulated capital gains tax liability is wiped away. On paper, the profit from the owner's lifetime disappears for tax purposes. The heirs can now sell a small portion of the inherited asset at its new market value to pay off the original bank loans. Because of the reset, they pay zero tax on that sale. This sequence ensures that a lifetime of staggering wealth appreciation transfers to the next generation without a single cent of capital gains tax ever being paid. This strategy is more than a niche tax trick. It is a foundational pillar of the global economy, supporting billions in private institutional credit. It exposes a structural divide in the tax code. W-2 wage earners pay taxes on their labor immediately, while asset owners use debt to shield their wealth for generations. The modern system provides a mathematical guarantee. The ultimate financial winners are those who can afford to never cash out.